Welcome to the Heart of Money podcast, where we discuss the personal and emotional elements of money and the impact that money has on every area of your life. I'm Austin Black, a personal finance coach that helps couples overcome their fear and frustration of financial management so they can take complete control of their money. What started as a desire to learn the fundamentals of money management has turned into a passion for helping couples work together to achieve financial success and strengthen their relationship with each other. Whether you're looking for the best strategies to manage your money as a couple, or you're tired of struggling to gain traction and want to overcome the fear and frustration associated with finances, I'm here to help, and this show is for you. Ready to learn more? Then let's talk about the heart of money. Well, most people think that in order to become debt-free and have financial security, you have to either make a lot of money or have a very restrictive lifestyle. And folks, I'm here to tell you that neither one of those is true. In fact, I have a training that's going to walk you through the financial freedom blueprint of how to accomplish your goal of being debt-free and having financial security without the need for a huge income or restrictive lifestyle. I'm only offering this training once a month live, so be sure and check it out for my next class so you can come learn the secrets, the tools of the trade, the strategies that I teach clients on how to get on the same page with their spouse, create a plan for their money, and accomplish their financial goals by managing their behavior. It's going to be a lot of fun, and I cannot wait to have you at the next class. So head on over to freedommoneycoach.com/training. You can sign up for free and join me for my next live masterclass on the financial freedom blueprint. That's freedommoneycoach.com/training. I'll see you guys next month. Hey folks, welcome back to the Heart of Money, episode 92. I am here with Mr. Bob Westler, who sometimes I make fun of, sometimes I welcome with open arms, and tonight he is just here with all his bald glory.
That's right. And you never know what's going to come out of my mouth. So sometimes you cringe, sometimes you laugh, and usually it's a nervous laugh because you're still not sure what's coming out of my mouth. And I usually just complicate things. So you're welcome.
And here we are.
Well, now that this show's shot, come and join us next time for episode 93, where...
You know, Bob, I get made fun of, but it's so true to form for us. You know, to be fully transparent, you know, we sit down, we usually do a batch recording of these. And by the time we get to the second or third episode in our time together, we usually are just so giddy and slap happy that we don't even know what we're going to say. It just comes out and we get to roll with it. So here we are, the number 3 recording of this session, and you never know what's going to take place.
I thought you weren't telling everybody our secrets. I thought we were trying to be good that, you know, when we did the Christmas episode at Thanksgiving, we were supposed to say Merry Christmas, not Happy Thanksgiving. Or, you know, when we did the Easter episode on the 2nd of January. No, we were not that bad, but you know, I try not to mention names, and I blew that the last time, and but that's fine. Don't put your money in someplace spending 0.5% or 0.05%. So, you know, I remember, or you just made the comment about being made fun of, and somebody told you had to tell more dad jokes. I haven't heard you say any dad jokes. But I just thought of one that I heard earlier today was, why did the cowboy buy a dachshund?
A dachshund?
Yes.
Oh, goodness.
Because somebody told him he needed to get a long little doggy.
Wow, wow, wow.
And that's as good as bad as it gets. So stay tuned for episode 94 when we go back uphill with better financial advice than we're giving you here. So...
You know, the scary part of this whole scenario is once we get to the 3rd episode in our recordings, I really do never know what you're going to say.
That's right. And he's probably just going to cut everything we've talked about for the last 20 minutes. Just joking, we've been here for less than 3. But if I say 20, you'll be like, man, they've been talking a lot. They probably think that already. Man, they talk a lot. Would they just get to the point? Which is your segue, Austin, where you can just get to the point of what we were actually going to talk about this evening. You're welcome. That's what I'm here for.
Well, I have no idea what you've been talking about. So,
for the last 20 minutes.
Yes, in true the heart of money fashion. Anyway,
So there we were with the dachshund.
it is a good time, and we do have to record these in group function to make it easy on us, and that usually ends up with us being longer into the night because we record these in the evening and get a little bit goofy and silly, but we always, always, always try to bring valuable insight, information, encouragement, and accountability. Does that
And
sound sophisticated enough?
it sounds sophisticated, and that just tells me that anything I say for the next half hour gets pulled from the final cut. So
Well, at least we're on the same page.
that's right. That's right. So this is the last you've heard of me for this episode. So stay tuned for episode 95, where I'm back in the studio. No, I'm trying to make it an episode 100. Let's see.
We're not that far off. Just be good.
Think good thoughts. Think good thoughts. Think good thoughts. So we're going to expand a little bit on what we talked about before. What is that?
Yes, we're going to build on the blocks of financial management in our final episode of the savings series. And this one, I think it's probably a pretty cut and dried topic. You're saying no? You don't think it is?
Anytime you say cut and dry, we go about 3 times longer than you expect. I don't know. We'll find out.
It's because you always have tangents.
That's right. Rabbit trails and a differing opinion.
And bunny hops and
Dachshunds.
yeah, that's just dachshunds exactly.
Just get along, little doggy. Come on.
Well, in this one, we're going to talk about probably the thing that can bring the most confusion, I'm going to say, to a savings strategy, and only from the standpoint of which one do you do, Bob? We have throughout the entire series we have talked about savings. We've also talked about investing, which is obviously a form of savings. But when I break it down, savings is essentially putting money into a just bank account, whether that be your actual bank or money market or something easily accessible, low risk, moderate to low return, but it's just you're literally saving money. Investing, you are putting money into the market for a higher return, higher risk scenario, but with long-term goals. So that's kind of the definition difference, as they are both saving strategies. But they're kind of, I think there's a different time and place for each one of those. And for folks who maybe are still learning how to manage their money, how to take control of their money, how to be financially secure and independent, they may be confused around, do I need to save it or do I need to invest? Because investing is going to bring more return for your money, but sometimes savings is a safer way to have money. So I want to bring our thoughts and ideas around the differences. When is the right time for each one? What's the benefits and disadvantages of each one for your scenario? And kind of wrap up this series with just the question that might help people get started the right way. So that's kind of where my head's at. What do you think?
Oh, there's all different kinds of things I could say, and I've got my mind going on different routes that we could take with this. So I'm really more interested in what your questions are going to be and how I look at them for different scenarios. Because as we've talked about with a lot of these talks, is it depends on the situation, and it depends on the age of the person. It depends on where they are in their life and where they're needing money or where they're not needing money. So yeah, I'll take some shots at your scenarios. We'll see what you have and how agreeable or disagreeable we can be.
It's a unique facet about money that whatever you do is what the end result is. Because a lot of times
that was pretty
people
deep.
Feel like, what's that?
That was pretty deep. Could you
it was deep, yes. I'm gonna keep digging if you'll let me.
Okay. Should I stop you now to keep you from digging further? It depends on
So, we run into a lot where people let money happen to them, right? People let life and money happen, and they take the results, they take the repercussions, and they just deal with it. Well, the fact is that if you let money happen to you, you will never be able to take control of your money because you're going to be the one at the mercy of it. Well, money is only going to do what you tell it to do, and it's not going to do what you don't let it do. So if you manage it, it's going to work in your favor. If you let it run free and clear and you let it happen to you, you're going to be at the mercy of your finances. And I think that's a lot of times where people find themselves, and why they come to us is money just kind of does its own thing, and they're trying to figure out how to put a wrap around it and manage it and get in control and make it work for them versus them working for more money. So with that whole mentality, whether you save or invest, you're going to tell your money what its job is, in my opinion. And like you said, Bob, there's different times, different phases, different places for each one of those strategies. You and I were talking before we started recording of what is the separation. And I look at savings as putting money aside to have as a buffer against the unknowns, against emergencies, against large expenses that we aren't expected. Typically, you're going to put it into a bank account or into a high yield savings account, into a money market account where it's easily accessible, where it's low risk, probably low return because of just the fact that it's not doing anything for you except being your insurance policy or just your nest egg in a very basic sense. Investing, on the other hand, is making your money work for you by putting it into the market, whether that be through retirement or through general mutual fund investing. But you are putting your money out there to gain a higher interest, a higher return, and also incurring higher risk. But you're doing so with a long-term goal in mind, a long-term approach and objective. And because you're in it for the long haul, you're willing to take some hits along the way because those hits shouldn't really change where you end up. So that's my separation and distinction. And the reason that I think people sometimes get confused around, well, what do I need to do and where should my money go and how do I make it really work for me as I'm trying to figure out this whole money management concept, is they get nervous that their money's not going to do enough if it's just sitting in a savings account. And they're also concerned that their money's going to be at too high of risk sometimes if it's in an investment versus a savings account. So there's two kind of fears and hesitations around the lack of understanding of where you need to be with that. And that's what ultimately ends up in people making the wrong decision.
Yep.
So that's kind of the separation that I have on what those two strategies are and why it can be confusing for someone to not know what the right process is because they want to avoid the pain of making the wrong decision there.
Well, I think you're correct on both statements. Is their money's not doing enough for them, or their money is in a position that's too risky. Both can be very much true. I think allocation is the important aspect of this. And we're coming at this from the standpoint of we're looking specifically at saving versus investing. Saving, you have money on hand. It is accessible when you need it for emergencies, for whatever. Versus the market, where your time horizon should be long-term. It shouldn't be 6 months. It shouldn't be 2 years. It should be, depending on your age, 5 to 40 years, possibly 70 years. A far stretch in that case, but you're not looking at something that's going to sit in the market for 6 months, because if you're in the market for 6 months, you're more likely to lose it than you are to gain anything off of it. There are some cases where people get lucky. You can't time the market. There are people that are professional traders that is their job. Mm-hmm. All they do is yell and squawk and buy and sell. They get paid to do that. They also get fired when they don't do it right.
Yeah.
That is not the position of most everyday, or it's not the position of most everyday investors. Uh, there for a while, and I'm going to put a couple of personal spins on this. At one time, I was a licensed banker, which means I had investment licenses to sell different funds and stocks and bonds. The biggest thing I took away from that was you don't ever put your money all in one basket.
Mm-hmm.
Is you diversify, 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 diversify. You know, in real estate, it's location, location, location. In investments, it's diversify, diversify, diversify.
Yep.
And it's the same thing with saving versus investing. You're diversifying between the two vehicles. If you're not earning enough on your savings, look at other options to where that money is available to you, but it's earning some return, especially in our current environment. Investing, one of the, and I'm probably going to go out on a limb a little bit here, people that borrow against their investments are taking a loss. They take loans out against 401ks, whatever it may be, because they don't have money in savings. So, again, as we've hit on multiple times through our conversations, have money in your savings. Have money that will do something for you when you need it. For an investment purpose, that's money that, from a starting point, is money you're willing to lose, because in the market, and I'll go back to when I was licensed, in a bank, you have an FDIC sign, because the FDIC, Federal Deposit Insurance Company, will protect up to $250,000 of your money in a bank should the bank fail, per person. I'm not going to get into the rules. But if you sell investments, you have to make a stated point that you remove the FDIC sign off of your desk and say, there is no guarantee that you're going to make money with this. You could lose all your money. There is no insurance on this, on any of your transactions. So day trading or short term is not what investing is about. Yep. I can go on, or if you have other topics to that aspect, but I would say on a time horizon, one of the things with investing is you have to have your savings. But if you're working a job where somebody provides a match, don't miss out on the match. And if that's all you do with investing in a company, in a 401k, whatever it is, take the match, because that's free money.
Yeah. I think you gave a really good outline of the separations, especially from the banking standpoint. I have seen, not a whole lot, but I've talked to some people that they feel like just saving money is not necessarily a waste of time, but it's not a good use of their time for that money. In other words, because they're not really getting a return on that investment, it's almost like, well, the money's not doing anything for me. You know, kind of like I said earlier, it's just sitting there. Mm-hmm. It's, not really happening. Because you need to have that protection, like you said earlier, you need to have some form of savings that's easily accessible, that is, not going to have any major loss to it. I've got our savings right now in an online high yield savings account, 5% interest. It's making me way more than if it was in the bank itself, but it's not doing anything for me long term. It's just there to have money accessible, and I'm making good interest on it. Now I have a substantial amount of money in investments, in retirement and mutual funds and kids' college, that is garnering a very good return, and it's also at a moderate level of risk because of the market fluctuations. I also don't plan on touching that money. Probably the soonest I would be touching it would be within about 5 5 years, and that money is in an account that is slated for a earlier withdrawal. So it's not, it's pretty balanced, pretty safe. It's earning more than if it was in the savings account, but I'm not at that 20% return and potential of minus 30% return type scenario. So it really does depend upon your scenario, your goals, your situation. Across the board, I feel like people who only save and don't invest are going to be at a loss in the long term. At the same time, people who minimally save and go all in on investment are at higher level of risk. So if you're in that standpoint where you don't have a secure nest egg, and by secure I mean it's the low risk scenario, and you're throwing all your money at this higher return, higher risk opportunity because you want to make your money work for you faster, unless you can get by with the minimal savings, which I doubt you can for very long, and you plan on using that strategy for a long time, that is not going to, it's not going to get you the return that you're probably expecting. On the flip side, with that first scenario, if you're only doing the savings for the safety and security, to be quite frank and honest, I feel like you're not being a good steward and good manager of your money. Now, I say that with the admittance that not everyone is comfortable with an investment strategy, and I totally respect that. I understand that. But from a management standpoint, you're losing out. So if you are trying to be a manager, it's not a good management strategy. Now, I'm not going to say that someone has to invest. I don't want that to be the connotation, but the reality is you're not managing the money to the fullest, in my personal opinion. So hopefully that would maybe clear up any confusion around the two, kind of give some guidance, give some outline. Is there any part of that you kind of have any separation on, you think?
Well, I think you made the comment that somebody's got their money in savings and it's not doing anything for them. If it's making 5%, it's doing something.
Oh, yes.
If it's making 5%, it's doing something. So it's not just sitting there, but it's not making as big a return as it could. The only thing is, if you put that money in an investment, specifically in the stock market, like you said, it could make 20%. It could make negative 30%. You could end up, the opportunity cost of I've got money sitting in the bank making 5%, or I've got money sitting in the market that I'm going to need fairly soon. And all of a sudden, all that money I put in the market is worth a third of what I put in. That's even worse from a stewardship standpoint.
100%.
It is a time-sensitive investment. And there are different types of investments. There's straight stocks. There's mutual funds. There's exchange-traded funds. Money market from a standpoint. CDs are an investment because they're not liquid. And if you take money out of a CD, it costs you money.
Right.
Depending on your time horizon again. So really, to have a mindset that your money's not doing anything in a savings account, it's doing something. It has to be doing something. And if it's not earning money per se, it's providing you money and security when you need that money. Because if you go to the market and pull that same money out, it might not be there.
Yeah. I'm still amazed at the fact that certificates of depreciation, CDs, are actually gaining the percentage that they're gaining now, because forever you were honestly losing money by putting it in a CD because you were not even keeping up with inflation. And like you said, if you took that money out, it was going to cost you. So yeah, it was probably the safest place to put money. It was not the smartest place to put money. Now you can't really have that argument anymore because the CDs are running, 3 to 6% in most places, which is just, I never dreamed I would see that type of return. And
you're not old enough. That's why.
Right. Yeah.
Yeah.
And it's, thank you for clarifying. It's not that your money's not doing anything, but comparatively to what you could be doing, you might as well. I mean, it's a scale, right? It's
Yeah.
a comparison analogy, because if you took that same money and you did put it in the market and it was gaining 20%, 5% is nothing.
That's
So
right.
yes, 0.15% is still something, but it's nothing compared to a 5% high yield savings account. So all along the way, the whole concept of, is your money doing the most that it could do?
Right.
And there is absolutely a place for putting substantial amount of money into just straight savings, especially if I'm going to need this money in 3 years, like you said before, that short term frame of mind.
Or you don't
And
know
that's
you
where,
need that money.
right. And that's where you got to start.
Yeah.
That's where the savings strategy start, is saving money in an accessible manner, in a low risk manner, in a way that I know I've got it when I need it for whatever I need it for. And once you've got that built up, once you're comfortable and confident with that, once you've, I would even recommend to focus on the savings and then focus on your debt, not necessarily including your house, and then really lean into the investing. And I know there's arguments around investing for that match all along the way. I personally don't. I flip and flop on which side of the fence I go on with that, because I think depending upon where you are and how soon you could accomplish one goal or the other, you might be better off if you've got a bunch of debt that you want to pay off, taking all your money, getting that debt out of the way in 2 years, 3 years at the most, and then come back around to your retirement. I don't think that you're going to lose a lot on that line. Now, if we're talking, we commented on this last episode. If you're talking about a longer term time frame, okay, I want to get the house paid off. It's going to take me 17 years to do that. You don't want to wait that long to be contributing to retirement. And that is going to hurt you. So my personal philosophy depends upon what time frame you're in. If you want to be truly investing, or if you still need to be savings, debt, and then investment strategy. Hope all that makes sense. And is there anything there that you think I'm missing on that distinction?
Going back to your previous comments about the security of money, and really we're focusing on time horizons with savings versus investing. If somebody is risk averse, maybe you're in a case that money, you're thinking, oh gosh, I need to put it in the market, but you're risk averse and you actually get more in a savings account right now, don't put it in the market. Yeah. But like I said, with all the different types of investment vehicles there are, you can put it in bonds. Typically safer, doesn't make as much as a return.
Yep.
And you talked about CDs. I had customers when I was in banking, when I met with customers that had CDs that they'd laddered for years. Yep. Here's a bonus tip. If you have a CD and you get a promo rate or a special rate on it, when it comes due, check to see what the rates are currently. Don't let it just roll over, because you'll be back to that 0.05% because it's not going to be making anything for you. Again, if you need money, if you have money, need to set aside for expenses, not expenses, but for emergencies, don't put it in a CD. CDs right now, it's not worth it to lock it up for any amount of time, because you're just as well off in a savings account as you are with a CD. Back in the days when the interest rates were 18% for a car loan, they were also 18% for CDs. So again, we were in a time period when I was very little that you were either in a very good spot if you had money, or you were in a not so great spot if you didn't have the money. But that's where that customer laddered CDs, and he and his wife would come in, and every 6 months to 3 years, They had different time frames, and they had a schedule, and they knew how that money, when it would turn over, what the rates were. You have to watch it. You have to be aware. It's more involved than just sticking it in the market and letting it run. But it's not as risky either.
Would you classify a CD just from the comments you made there of having to watch it and essentially manage it? Would you classify CDs as savings or investing?
I would classify them as investing.
Okay.
Because they are not liquid.
Yep. So that's interesting concept, because I've heard about people, and I have family that does this, that, they watch those accounts, and whenever it's up for renewal, they're looking for the next rate and everything. And that is their savings / investment strategy. I mean, that's as basic as complicated as it gets. It's pretty basic still. But that's interesting, because compared to investing itself, like in the market, CDs to me almost feel like a savings strategy because of the overall return. So is it just because they are locked up and not accessible that you would classify them as investment, since they are kind of that very safe, very secure, low risk portfolio piece?
Yeah, they're low risk. You're guaranteed that return. They're not something that you can immediately withdraw from. You can, but you lose X number of months of interest, or there's a penalty. There's not a prepayment penalty, but a withdrawal penalty for not leaving it in until it matures. So I deem that it's not a savings strategy from the standpoint of, if it truly is savings, there is a purpose for it that you need it in a short term. Now, if your saving strategy is, I don't need this money for 6 months, 9 months, 12 months, 3 years, whatever, but you have a purpose for that money, you could incorporate it into savings. But I would say that a CD by itself is not a smart savings vehicle.
Yeah,
it's not where you want to put your money.
I would agree with that philosophy. I guess, yeah, I personally wouldn't classify as investing, but I see why you put in that bucket. But I do agree that it's not the best savings approach for sure.
I think that in the age of Scottrade, E-Trade, Fidelity, everywhere that you can, or Robinhood, whatever, where you can trade on portions of a share, CDs are from a bygone era where you could go to the bank. Back in the day, you looked in the newspaper and you looked to see what the interest rates were.
Yep. I do remember that.
Yeah. and there were probably schedules too.
Yep.
But your investment, you didn't pay somebody to move your money for you. You didn't pay fees for somebody to do it. So I'm not going to say it necessarily was a poor man's investment, but it was for somebody that had money that they wanted to keep it at their bank. They got a good interest rate on it. It wasn't highly risky, and they weren't paying anybody to manage it.
Do you see it being utilized by anyone under the age of 50 these days?
Right now, no. Again, it depends.
Yeah.
Somebody under the age of 50 that has a significant amount of money that wants to sock it away for later, or has an intended purpose for it that can get a good rate, because 5 to 6% on a CD is not a good rate right now. If savings was making less than 1% in a savings account somewhere, 5% would be fantastic. But why lock up money that, if you did need it, would cost you money to get, if you can get the same return in a savings account? But it's always going to be dependent on a person's situation. Somebody under the age of 50 that is making enough to have a covered savings account that has emergency fund and 20,000, 40,000 in the savings account, has maxed out their Roth IRA, has maxed out their match. Um, if you want to go as far as they've maxed out what they can in a 401k, you run out of options.
Yep.
If somebody's more risk averse, in electronic trading now, you stick it in a mutual fund, you stick it in an exchange traded fund, you do dollar cost averaging, but CDs are kind of on the backside of it because they're not making as much of a return for the fact that you have to lock those up for 6 months to 5 years or 10
Yep.
years, depending on what you're looking at. And the return is just not significant enough to have to pay the penalty versus getting it as a liquid return.
And I feel like people under the age of 50 these days are more conscientious. If they are doing some form of savings and investment, they are more conscientious of what is the return on my money versus how safe and accessible is it, right? They almost want to make the money get the highest return possible and aren't as concerned with, I might lose 50 grand in the next 5 years if I do this, compared to, I want to have 50 grand accessible for the next 5 years. I might be off in that assessment, but I feel like that's kind of, the generations that we're in right now are more focused on how much can I get for what I have than how well can I protect what I need.
Yeah. Now you drop that from somebody that's near 50 years of age to somebody that's 25. Yeah, absolutely not. There's no need to have a CD at 25 years of age, unless you're coming off of a trust fund and have no place to put it.
Right.
But there are plenty of other places to put it besides a CD that is, in essence, locking up those funds for a given amount of time.
Yep. As always, fun, enlightening. It's Bobby. It's always interesting to see where we unite and where we split, and it all comes down to the same things around what drives your decision. It's a customized approach. It takes into account many different variables, and it's something that experience will dictate what you want to do. And I think this is no different. I think we both agree that there's a time and place for savings. There's a time and place for investing, and being smart in both of those areas is very important because there's good options, there's not as good options, and to be a good manager, you need to know what is the purpose of this strategy and is it going to benefit me long term. And as we've said with every single episode in this series, that is what a coach can help you with. And I'm going to pull that out, more and more because I think we do a disservice if we don't provide people the opportunity to improve themselves. So, this podcast is here for education, for encouragement. It's also here to give you an invitation to work with us and to find someone that can lead you through the trenches, to help you climb the mountains, to walk through the valleys, to learn how to win without making all the same mistakes that we made, and to get there faster than you thought possible. That's what we're here for. That's what we do every single day. So, if you want to take part in that journey, reach out and take the first step for that. Bob, is there anything else that you want to add to this conversation before we wrap up tonight?
No, I had something floating around in that brain of mine, and like you said many times earlier, they said you just weren't sure what was going to come out of my mouth, and I continue to surprise you, some with a few nuggets of wisdom. But yeah, I think any thought that I had that was going to go along the lines of investment, and you stated it, learning from our mistakes. You're not always going to win in investments. You're going to make mistakes. You're going to lose money. It's risk. It's how it works. If all you did was ever win big in the market, the risks would be a lot less.
Right.
But I think one of the things with investing is you take your licks, you realize when you screwed up or when you take a loss, and you bounce back and you keep going. You don't tuck your tail and say, I'm done with it and I'm going to put all my money in CDs from now on, or I'm going to just put all my money in savings. It's knowing what the objectives are, again, what your time horizon is. And if a strategy didn't work, figure out why it didn't work, what you need to do different, and do something different rather than just hanging on, grinning and bearing it, and just sticking it out. In some cases, you do have to stick it out. But other cases, it's time to say, you know what? I've lost my money on this. There are better places to put it. I'm pulling it out now. Because it could be that you're in a spot that you've lost $20 on whatever amount. You've lost 20%. Let's say it better that way.
Mm-hmm.
If you leave it in there for another day, you could make 5% back, or you could lose another 50%. There was something I saw the other day, a stock that was worth significant amounts of money. It's now trading at 53 cents.
Holy smokes.
Yeah. There's some fraud that goes in on that drop the value, but Forbes is a great place to see people that are the most wanted in a few years too. So you really have to get in with somebody that knows what they're doing, realize that it's not sunshine and roses, that there are going to be lessons learned along the way, and it's always better to learn from somebody else. But don't hang on for dear life when you know it's better, or you have that gut feeling that it's better to get out and do something different. Because that's why investing is a long-term deal. It's not something you do for weeks or months. And again, there are people that get paid a lot of money or get fired if they don't do that right.
Yep, 100%. Well, folks, hope that you enjoyed this series on savings and that you feel, as always, encouraged, empowered, enlightened, challenged, motivated, excited by all things that managing your money well can do for you as you take complete control of it. And Bob and I always have a fun time sharing stories, swapping ideas, arguing, challenging, supporting in our conversation, and looking forward to the other conversations we have scheduled for the rest of this year. Bob, we're going to get to involve the wives here again upcoming in the months, so that's going to be fun to talk about what we do right and wrong as we manage our money together. You kind of get drug along on occasion, but I know they always bring some fun insight to those conversations, so looking forward to having them as well.
I'll make sure I get the black eye after the fact versus showing up with one. So,
good idea.
Yeah.
Just say yes, dear.
Yeah, yes, dear.
All right, folks, thanks so much for tuning in, and we'll see you next time on The Heart of Money. Hey, folks, did you find today's episode valuable? If so, I would truly appreciate it if you left a 5-star review and shared the episode with a friend. My goal is to help as many couples as possible in their journey to gaining complete control of their money. Also, I have a free gift that I want to share with you for taking the time to listen to today's show. I have a brand new video training that outlines 5 steps for making a budget that will give you true financial freedom. In this training, I share how you can create a budget in a matter of minutes and make it easy to implement. Who doesn't want that, right? You'll learn what categories you need to cover all the bases each month and how to protect yourself against financial stress. You can access your free gift at freedommoneycoach.com/budget guide. That's freedommoneycoach.com/budget guide.